Welcome back to the Manor. Julian McBain here. And we are back with Personal Finance for Gamers. Gotta figure out which weapon I'm using. Here we go. Oh, it's been a day. So today we're going to be talking about stocks. And I'm not talking about any specific ones. This is an educational piece based around what stocks are and how they work. But before we get started, if you're new to the channel, welcome to the Manor. Please take a moment and subscribe down below. We are on the road to 13 million subscribers, or one subscription at a time, so make sure you subscribe. Also, consider going to patreon.com/JulianMcBain if you want to support my work. If you do, you'll get exclusive content. January's exclusive is out. I'm pretty sure this video still drops. No, this video will drop in February. That's right. This is the Wednesday video. So I have released January's exclusive. February's exclusive, of course, will come out sometime this month. So there you have it. Also, y'all should know I am participating in the Phase 1 challenge. And so I will be releasing a unique piece of content specifically for that. You'll also start seeing an uptick in other game content being uploaded. I'm currently working on the Boneworks series. In fact, I'll be working on that for probably an hour, hour and a half after I'm done with this video, which is amazing because I just got done doing like 5 hours worth of fucking schoolwork because I'm crazy and decided to take on a full-time course load in my first term along with working full-time along with doing this because I'm crazy. Okay, let's get into it. Before we get started on the content itself, I have to make my standard disclosures. This keeps FINRA happy and keeps me out of jail. I'm not a financial advisor. I'm not registered to this is not to be considered financial advice. Please see a financial advisor if you need specific financial advice for your situation or their equivalent in your country. Securities are not FDIC insured, carry no bank guarantee, and may lose value. If you're not in the United States, if there is an equivalent agency to the FDIC, I doubt they're covered by those either. Okay, so what is a stock? A better term for a stock is called an equity or equity stake. It means you're partial owner in the underlying company, the company that issued the stock, in an amount equal to the number of stock shares you own over the total number of shares the company has ever issued. So sometimes you'll see there was an old commercial where it said, "Oh, my dad owns Nike," and they're like, "Oh, we're gonna be rich," and it's like he is 0.0000001% owner of Nike. Yeah, because he bought a block of 100 shares. Yay! So it is an ownership stake in the company. Comes with certain rights and benefits. A stock may or may not be publicly traded. Publicly traded stocks may or may not always be on an exchange. What does that mean? Okay, well, everyone knows about the New York Stock Exchange. There are multiple stock exchanges all over the world. The New York Stock Exchange is probably the most famous and or infamous. So, publicly traded companies where they put their stock on the open market for people to buy, as opposed to privately traded companies or private companies where you have to be solicited by the company directly. You really can't sell those shares, or there's restrictions on the trading of those shares. Are often on an exchange where they're freely purchased and sold. Some companies who are of low volume may not be of enough price. They're not qualified to be on one of the exchanges, such as the New York Stock Exchange, the S&P, or the NASDAQ. They're traded over the counter. We used to call them the pink sheets because they used to be listed on literal pink pieces of paper. Over the counter, you'd purchase them directly. This is where your penny stocks usually are. And they also tend to be highly volatile, hard to get rid of, and so are a high risk investment. Okay, so what are the common types of stock? Funny I should use the word common. There are two forms of stock that are most known about. They're the ones that are most commonly exist on the market. They're the ones that most companies issue. The first, of course, is common stock. Common stock is a voting stock, a voting share in a company. You are entitled to vote each of your shares in the shareholders meeting. So if you have 100 shares, you have 100 votes. If you have 1,000 shares, you got 1,000 votes. Now, obviously, you're only going to vote once, but once per opportunity, but it would be equal to 1,000 votes going to that person. Like if you're voting for a board of directors, you vote once for each seat that needs to be filled on a board of directors. If you vote for person A and for person B, they each receive 1,000 votes because you have 1,000 shares. That's how that works. They're also entitled to dividends. What is a dividend? A dividend is when the company takes profit over its needs and then pays it out to its shareholders. They try to do this quarterly. Here's the thing. Common shares, the value is usually widely distributed among a huge number of shares, so it's uncommon for you to receive more than $1 in dividends. And sometimes it's even less than that. Sometimes it's pennies. 2, per share. Per share. Let me be clear about that. It's per share. So someone with 100 shares, they declare a dividend. They say they're going to do a $1 dividend per share. A person with 100 shares gets $100. A person with 1,000 shares gets $1,000. That's how that works. Okay. That's one of the benefits. 2, you get to vote. Drawbacks. In the event the company folds, you're the last person to get any money at all. You bear the highest risk if the company goes belly up. Caveat. You can never lose more than the value of your shares. Let's say that again. You can never lose more than the total amount of money you have invested in that company. So you do share some liability, but it's not like if the company goes belly up and let's say that the company you're invested in screws up a product. Someone dies, right? Smaller company. Class action lawsuit. Wipes the company out. You lose your investment, but they can't come after your home. That's the easiest way to describe that. And there's a lot of legalism that goes in there. I am not a lawyer. I'm not going to get into it. But that's how that works. That's the short version. Okay. The other form of commonly known stock is the preferred share. Preferred shares are often treated like a liability, not an equity stake, by the company in question because they pay out a percentage of what the par value of the stock is. Unlike a bond where the company is obligated to pay every single year a certain amount of interest, usually quarterly, to the bondholder, you are not required to pay out a preferred stock. But if they declare a dividend, the preferred shareholders must be paid before even 1 penny goes to a common shareholder. These are the benefits to preferred shares. Preferred shares dividends are usually calculated as a percentage of the par value. That par value is almost universally $100. What is a par value? Par value is the assumed value of a share before it ever hits the market. So, oftentimes, if you form a corporation, you go down to your Secretary of State and say, I want to form, John Doe Incorporated for the purpose of any legal purpose. Now you've got a corporation. You do the minutes and you tell them what kind of, you have to put an initial amount of shares and you say, I'm going to do 1,000 shares, common stock. And you're going to do 50 shares of preferred stock. The par value of the common stock is usually $1. It's usually $1 because there are states out there that tax you on the total number, the par value of your total number of shares. Because of course they do. States are going to find all kinds of ways to tax you for everything under the sun. On preferred shares, it's almost universally $100. And let's say you've got preferred shares that pay out 5%. If the company issues a dividend, they're required to pay you, the preferred shareholder, $5 for every share you have. That's what that means. More importantly, if they can't pay out their preferred shareholders at their required percentage, common shareholders don't get anything. Yes, there are benefits to being a preferred shareholder, and this is why a lot of your CEOs and your C-level corporate execs get payment in equities. They're getting them in preferred shares. Now you're like, well, why wouldn't I always want preferred shares over common shares? You see, that's the drawback to preferred shares. Hard to find on the market, number one, but more importantly, preferred shareholders don't get to vote. Now, if you have preferred and common shares, you can still vote your common shares, but preferred shares don't get a vote. So you're trading your ability to your control in the company for a much higher payout, much more frequent payout. That's the balancing act between preferred and common shares. Now, there are a number of different ways that companies are organized. There are all kinds of different unique stock types. I was once in a company that had general and restricted shares, and it was the general shares that were held by those of us who were initially in that were voting shares, and the restricted shares were strictly for investment purposes. In the event that we ever released them, that company didn't end up going anywhere. We were trying to get into biofuels. The state of Vermont's restrictions on doing stuff like that, and the lack of availability of equipment at the time, made it functionally impossible for us to do. There were some zoning issues too, so we said bag it. We folded up the corporation. I think we spent like $150 total on everything. So it wasn't like we lost a huge amount of money. I think each of us lost like $30. So anyway, there are a number of unique ways you can form a company. Then you even have cooperatives or mutual benefit companies. And in these companies, each person working for them, you can only ever hold one share, and only employees hold shares. So you get employed by the company, you go through whatever probationary period and you receive your one share in the company. That's still a form of security. That's not publicly traded, and you can't trade it away. And I believe most of the time you're required to turn it in if you quit or are fired. But it's still classified as a type of security, even if it's exempt from a lot of the rules. Okay. Wow, we went through that a lot faster than I expected. Only 12 minutes in. So those are the facts about them. Did I miss anything is the question. Because I rolled through that a lot faster than I expected. Benefits to stocks over other forms of security. So what are the benefits of stocks over other forms of securities? The benefit of a stock, besides the fact that you're a partial owner in a company, is that their fluctuation on the market, based on the industry they're in, will be consistent with the market's fluctuations, generally speaking. What does that mean? That sounds like a whole lot of jargon. Well, in the last video, we talked about cyclical and counter-cyclical securities. If you have a cyclical stock and the market goes up, you're almost guaranteed that stock is going to go up. Not guaranteed, but it's going to trend the same direction as the market. Conversely, if you have a counter-cyclical stock and the market goes up, that stock is likely to go down. It's fairly predictable. You can't predict what the market will do, but you can usually predict what your stock is going to do in relation to the market itself. And again, not universally true. There are always exceptions to the rule. Not financial advice. Talk to a financial advisor. They'll say that as a general rule. I'm correct me if I'm wrong. Put it in the comments. If you're a financial advisor, or if you visit your financial advisor and they say exactly the opposite, or any sort of thing that contradicts what I'm saying, then please put it in the comments, because I want to know, because those are things I need to know. But the movement of them is semi-predictable, and it's always with the market itself. Unlike, say, a bond, whose value goes up and down with what the Fed decides is going to be interest rates, or the LIBOR rate, depending on where you live. Actually, I don't know if the LIBOR rate affects it, but it's not direct, like when the Fed moves the friggin' interest rates around, like they're going to do like 6 times this year. So that's the benefit of a stock over other forms of security. The drawback, volatility. Often, a lot of stocks are volatile. The smaller the company, the more volatile it is. And so there's a benefit and a drawback to volatility. The benefit to volatility, you can win big. The drawback to volatility, you can lose big. It's like in games when you have certain weapons where you have the highs are higher but the lows are lower. Same idea. Particularly with smaller companies. So when it comes to stocks, that's the information you need. I'm not going to drag this video out anymore. Y'all know I much prefer 20 to 30 minute videos. If I manage to get all the information out in 15, I'm going to hold to my promise not to deliberately drag videos out. So again, I am participating in the Phase 1 challenge. Expect that challenge video to drop sometime in the next week or so. And with that, thank you for watching. Thank you for listening. Please like, share, and subscribe down below. We are on the road to 13 million subscribers, one subscription at a time, so make sure you subscribe. And as always, I really appreciate the support, and we'll see you in the next one.